Welcome back everyone to Understand Trading. Today we will be discussing why mutual funds sahi nahi hai. Before we start, please don't forget to subscribe. Let's dive in. Today I've got some interesting stats to share with you about mutual funds. Did you know that 88% of the large cap funds fail to beat the index benchmark? That's right. Despite all the resource and expertise at their disposal, the vast majority of these funds underperform compared to the market. And it's not just the large cap funds. When we look at small and mid cap funds, 73% of them also fail to beat their benchmark. This really puts into perspective the challenge fund managers face in trying to outperform the market. The expense ratio of mutual funds. Have you ever seen a tab with expense ratio, exit load, and tax? The expense ratio is the annual fee that mutual funds charge the investors to cover the fund's operating expenses. This fee is expressed as a percentage of the fund's average asset under management. While it might seem like a small number, it can have a big effect on your returns over time. For instance, let's say you invest in a mutual fund with an expense ratio of 2%. And if the fund earns a return of 8% in a year, you'll actually only get a 6% return after the expense ratio is deducted. Over the long term, the difference can really add up. Consider this: if you had invested 1 lakh in a fund with a 2% expense ratio and it grows at an average annual rate of 8%, after 20 years you would have about 3,20,000. However, if you had invested in a fund with low expense ratio of 0.5%, like the direct mutual funds or the index funds, you would have around 4,30,000. That's a difference of 1,10,000 just because of the lower expense ratio. This example highlights why it's so important to pay attention to the expense ratio when choosing mutual funds. So you'll be wondering, what is a better alternative when my core is not the stock market of picking individual stocks? So what can be done? I have a solution for you, and that is an ETF. ETFs are exchange traded funds. So one of the biggest advantages of ETF is the lower expense ratio. Unlike mutual funds, which often have a higher management fees, ETFs typically have much lower cost. This means more of your money stays invested and continues to grow over time. Another major benefit of ETF is their high liquidity. ETFs are traded on stock exchanges just like individual stocks, so you can buy and sell them throughout the trading day at market prices. This flexibility allows you to react quickly to market changes and manage your investments more efficiently. Additionally, ETFs offer a great option for those interested in intraday trading. You can pledge your ETF holdings as collateral for margin trading for a haircut of 10%, which is very minimal, providing you with more opportunities to maximize your returns. In summary, I have listed all the advantages of ETFs. Thank you for watching.